S&P 500 and Nasdaq 100 futures are totally flat this morning. I mean, they are trapped in an incredibly tight range right at the implied open.
Yeah, pre-market volume is remarkably uncomfortably quiet today.
Completely dead. And the overnight session catalyst driving this paralysis. As of last Friday, Jerome Powell's term as Federal Reserve Chair officially expired.
Right.
So the seat is, as of this very second, empty. We are in the middle of a massive global energy shock. Inflation is, proving incredibly sticky, and the entire market is looking at the Fed wondering, who's actually driving this thing?
Which is exactly why nobody wants to make the first move.
Exactly. So for those of you stepping onto the trading floor right now, you are at a historic institutional crossroads. Today, we are unpacking a highly detailed pre-market strategy brief from the institutional desk at Bulls, Bears, and the Bell.
The date is Friday, May 22, 2026.
The opening bell has not rung yet. Our mission with this deep dive is to translate this dense, trader-focused dossier into, actionable insights for you. We're decoding the jargon, figuring out the overnight session, and tracking how the biggest players are positioning themselves.
And that leadership vacuum at the Fed, it's completely validating the anxiety we're seeing in the order books. Institutional money hates uncertainty more than anything else.
Oh, absolutely.
Having an empty seat at the head of the central bank during an inflation fight, I mean, it's the ultimate uncertainty. There's no clear guidance on monetary policy right when the market desperately needs a referee.
Okay, let's unpack this, because that Fed uncertainty is really just setting the mood. The actual pre-market action, or, paralysis, is being dictated by this massive macroeconomic tug-of-war.
Right, it's a huge clash.
Reading through these sources, it feels less like a market and more like a physics experiment. It's like trying to sprint through waist-deep water.
That is a much more accurate way to view the landscape than just, the typical bull versus bear narrative.
Right. You might have an incredibly powerful engine pushing you forward, but the environment around you is so dense with friction, you just can't gain ground.
Because that powerful engine is the sheer brute force momentum of artificial intelligence. But the friction, the waist-deep water, is severe geopolitical reality.
So on the engine side, we have NVDA. They just dropped a staggering $300 billion revenue guidance for 2026.
Which is just a mind-bending number.
$300 billion. Normally, that would have the entire market going parabolic, gap, and go right out of the gate.
Yeah, absolutely.
But then on the friction side, we have this grim, fresh report from the United Nations. They just slashed global growth forecast down to 2.5%.
And they directly cited the instability in the Middle East for that cut.
Right. And I want to be clear here for you listening. We are simply reporting what is in this institutional dossier. We aren't taking sides on the geopolitics or endorsing any political viewpoint.
We're just looking at the data.
Exactly.
Yeah.
But the dossier makes very clear how institutional capital is reacting to the prolonged blockade of the Strait of Hormuz.
You can see that friction manifesting in the specific pre-market gappers this morning. ExxonMobil, ticker XOM, is up 1.2% right now.
Because crude prices are holding a massive geopolitical premium.
Exactly. Institutional money is looking at the flow of global energy and deciding that oil is basically the primary hedge against tech volatility today.
But I want to pull on a thread here that really stood out to me in the dossier. NVIDIA is actually down 0.8% in the pre-market.
Yeah.
How does that underlying logic work? I mean, they issue a $300 billion revenue guidance, which should be an absolute victory lap, and the stock drops.
What's fascinating here is that the market is entirely forward-looking, right? And institutional anxiety has shifted from digital demand to physical constraints.
Okay, what does that mean practically?
It's no longer a question of whether companies want to buy chips. The demand for the new Blackwell-Rubin architecture is just through the roof.
Right, they can't print them fast enough.
But what the institutional traders are sweating over right now is a widening bottleneck in the liquid cooling supply chain.
Wait, hold on. Liquid cooling.
Oh.
We are talking about the literal plumbing for the servers.
The plumbing, yeah.
Yeah.
The specific chemical coolants, the specialized pumps, and the actual real estate required to house it all.
Yeah.
These next-generation AI chips, they run so incredibly hot that traditional air cooling, the massive fans data centers have used for decades, it simply cannot prevent them from melting down.
So they need water or liquid running right through them.
They require complex, highly specialized liquid cooling systems piped directly to the racks.
Which means you can manufacture all the groundbreaking AI chips you want, but if you can't physically keep them from overheating, you literally cannot turn them on.
Precisely. And retrofitting an older data center with this kind of industrial plumbing, I mean, it takes years and billions of dollars.
That's a massive physical roadblock.
The dossier is highlighting that physical, real-world logistics are suddenly putting a hard cap on digital AI growth. The market realizes that NVIDIA's $300 billion revenue projection might get bottlenecked by, of all things, a shortage of coolant pipes.
That is a staggering reality check. The dossier is very specific about the boundaries here. It defines a line-in-the-sand support level for the bears between 7,410 and 7,385.
Right.
And it warns that if the price breaks below 7,385, it triggers a liquidation move straight down to the 7,200 floor.
Why is that drop so violent? Like, why doesn't it just slowly tick down to 1,700?
Because modern markets are heavily driven by algorithmic trading. Those support levels aren't just, psychological lines on a chart.
They're actual tripwires.
Exactly. They are zones where thousands of automated trading programs have placed their stop-loss orders. If the price drops below 7,385, those algorithms automatically sell to prevent further losses.
So it creates an avalanche effect.
Yeah, that massive wave of automated selling removes all the buyers from the room, creating an air pocket, a vacuum that just sucks the price down to the next historical floor, which is 7,200 in a matter of minutes.
On the flip side, the bull resistance, the ceiling, is up at 7,490 to 7,510. The dossier notes we are currently being kept afloat because Q1 earnings showed a really strong 28% growth. However, the S&P is currently trading at a 21 times forward PE ratio.
Let's translate that for a second, because that's a metric thrown around a lot. A 21 forward PE means investors are willing to pay $21 today for every $1 of earnings the company is expected to make over the next year.
Right.
Which basically means the market is priced for absolute perfection.
And that multiple really limits any immediate upside. When you are already paying $21 for a single dollar of future earnings, you need a massive unexpected catalyst to justify paying $22 or $23.
Yeah, you need a huge surprise.
Without that catalyst, the ceiling just holds firm.
And the Nasdaq 100 futures, the /NQ, they're dealing with the exact same claustrophobia, testing the 29,350 zone.
Yep.
The brief notes that sellers are heavily parked at the record high of 29,675, ready to take profits. And if the bulls lose the final line of defense between 28,570 and 28,300, a 5% correction instantly kicks in due to those algorithmic sell-offs we just talked about.
We also have to look at the macroeconomic headwinds pushing down on these index levels. I mean, you cannot analyze stocks in a vacuum.
Of course not.
The 10-year Treasury yield is grinding its way up to 4.58%. The dossier notes it has jumped about 12 basis points, which is Wall Street speak, for 0.12% in just 10 days.
That's a huge move for bonds.
It is. Furthermore, the dollar index, the DXY, is testing heavy resistance at 99.50.
Okay, I want to play devil's advocate here, because this might feel contradictory if you're just looking at corporate balance sheets.
Sure.
If Q1 earnings are up 28%, and we're seeing this kind of incredible corporate profitability, why is the institutional brief calling this a sell the news environment? Why is the smart money bracing for 5% corrections when companies are making so much money?
This raises an important question, and it's exactly where retail investors are getting blindsided right now. The dossier explicitly calls this the pain trade.
The pain trade.
Retail investors are sitting on their hands, operating on the old playbook. They're waiting for a peace dividend from Iran negotiations and assuming the AI rally will just, resume its upward trajectory.
Because the common assumption is that a market crash only happens if there is an economic recession.
Right.
If companies are growing, stocks should go up.
Yeah.
That is the fundamental logic most of us are taught.
But that logic completely ignores the brutal mathematics of duration assets.
I'll break that down.
Mega-cap tech stocks, the companies driving the Nasdaq, are essentially long-duration assets. This means a massive portion of their current stock price is based on cash flows they're expected to generate 5 or 10 years into the future.
Okay.
Those future cash flows are mathematically allergic to a rising risk-free rate, like the 10-year Treasury yield.
I see. Because if I can get a guaranteed, risk-free 4.6% return from the U.S. government today, the promise of a tech company making $1 5 years from now becomes significantly less attractive. I need a much higher potential return from the tech stock to justify taking on the risk, which means the stock price today has to come down to offer that higher yield.
Exactly the dynamic at play. Strong economic growth plus sticky, energy-driven inflation equals higher yields. The market is increasingly pricing in a no-cut 2026 scenario from the Federal Reserve.
Especially with that chair sitting empty.
Yes. So, even if NVIDIA's earnings are phenomenal, if that 10-year yield breaks above 4.65%, it triggers a forced deleveraging.
The algos kick in again.
Institutional computers will automatically sell the most crowded tech names to balance their risk models. It is not a growth scare where companies suddenly start making money. It is a valuation reset.
A reset.
Yeah, the 21 times multiple we discussed compresses down to maybe 18 or 17.
That is a sobering reality if your portfolio is top-heavy in tech.
Okay.
And briefly on the dollar index, the DXY, a strong dollar sounds good on paper, but if you're Apple or Microsoft trying to sell software in Europe or Asia, a strong dollar makes your products inherently more expensive for foreign buyers,
Right.
which just crushes your international revenue. It acts as another gravitational pull.
Correct. The stronger the dollar, the harder it is for multinationals to hit those massive earnings targets.
So if sticky inflation, rising bond yields, and a strong dollar are creating this toxic environment for mega-cap valuations, how is this macro tug-of-war actually impacting the real economy?
That is the big question today.
Right, if tech is allergic to these yields, what about everyday people? How is this hitting the average American wallet?
That transition from Wall Street to Main Street is the exact catalyst the institutional desks are waiting for this morning. At 10:00 a.m., the University of Michigan Consumer Sentiment Print is released.
The 10:00 a.m.
The entire street is watching this data point to see if the combination of high borrowing costs like, 8% mortgages and 22% credit cards paired with $100 oil is finally breaking the American consumer.
And the dossier gives us two fascinating corporate case studies to watch alongside this economic data.
It does.
The first is Booz Allen Hamilton, ticker BAH. They are testing a multi-year sentiment trough right now. The big question is whether their Q1 earnings print today marks a definitive floor after an entire year of contraction.
Booz Allen is a crucial bellwether for government and enterprise consulting. If their revenues are still contracting, it tells us that massive institutions and government agencies are actively pausing their spending.
And with the Fed chair empty, that kind of institutional paralysis makes perfect sense.
It really does.
But then there's the other side of the coin, which I found incredibly telling, ROST stores, ticker ROST. They are highlighted as the definitive defensive winner of the day.
Yeah, they had a huge print.
They completely beat their Q1 earnings expectations and actually raised their full-year 2026 guidance. Here's where it gets really interesting. I look at off-price retail stocks like ROST stores as essentially taking a thermometer reading of the middle-class wallet.
If we connect this to the bigger picture, ROST Stores' current success is a direct reflection of these specific macroeconomic headwinds we've been discussing. The dossier notes that ROST is actively capturing higher income cohorts right now. This isn't just their traditional customer base buying more, this is a migration.
It's the trade-down effect in action.
Exactly.
Families who, a year or two ago, would comfortably shop at full-price department stores are feeling the intense pinch of that 4.58% yield when they look at their variable rate debt.
Yeah, their credit cards are maxed.
And they're feeling the energy shock every time they fill up their gas tanks. So they're migrating down the retail ladder to ROST to find value just out of pure necessity.
And that observable shift in consumer behavior is why today's 10:00 a.m. sentiment data is so vital for traders.
How so?
Well, if that print shows that inflation expectations are ticking up in the minds of everyday consumers, the liquidity trap we talked about earlier, it snaps completely shut on the market bulls.
Oh.
A tick up in consumer inflation expectations virtually guarantees that bond yields will stay high, which means tech valuations stay heavily pressured, and the institutional decision to shift capital into defensive, trade-down plays like off-price retail is completely validated.
If I'm an investor looking at my own portfolio right now, hearing that tech hardware is trapped by plumbing issues and the consumer is financially tapped out, my instinct is to just, pull all my capital and hide it under a mattress until the dust settles.
Sure, that's the natural reaction.
So where exactly is the smart money hiding out before this long weekend? Because they aren't going to cash, are they?
Institutional capital rarely hides under a mattress. It rotates.
Okay.
According to the flow data in the dossier, the smart money is executing a very specific sector rotation this morning. They are actively rotating out of speculative AI-adjacent hardware companies, and they are aggressively piling into proven software and cloud SaaS leaders.
Software as a service. Okay, help me understand the mechanics of that shift. Why abandon the companies building the AI infrastructure to go back to the software layer?
Because enterprise cloud companies are proving they can do the one thing hardware is currently failing at. They can rapidly scale and monetize artificial intelligence without degrading their profit margins or running into physical bottlenecks.
Ah, I see.
A software company doesn't need to worry about the global supply chain of liquid coolant to roll out a new AI feature to 10 million users.
That makes total sense. The scalability of code versus the friction of physics.
Precisely.
The dossier spotlights two specific tickers here that really tell this rotation story. First is Workday, ticker WDAY.
Yeah, they had a great quarter.
They reported a massive Q1 beat. Their subscription revenue jumped 14.3% to $2.35 billion. And the detail that the institutional money is hyper-focused on is their new AI integrated layer, which they call Sana.
Right.
This AI integration is actually accelerating their net new business. The dossier has a bull breakout target for them sitting at $140.
Think about the narrative shift that represents, though. Just a year or two ago, the prevailing fear on Wall Street was that generative AI was going to completely disrupt and eventually replace traditional HR and finance software platforms.
That they would just write its own code and make them obsolete.
Exactly. Instead, companies like Workday have successfully absorbed that AI capability into their own ecosystems, using it as a premium feature to drive recurring subscription growth.
And the second ticker the dossier highlights is totally outside of the tech sector. Estee Lauder, ticker EL.
Yes.
They are gapping up 12% in the pre-market. Why? Because they just formally terminated their merger talks with Prig.
Right, the deal is off.
They're launching a standalone turnaround strategy dubbed Beauty Reimagined, and they're focusing purely on hitting a 13% margin expansion for fiscal year 27. Their bull target is up at $90.
Yep.
So what does this all mean? When I look at a cloud HR software company like Workday and a cosmetics giant like Estee Lauder side by side, the common denominator seems to be that investors are just aggressively paying for certainty.
That's exactly it. Certainty.
Workday gives you highly visible, mathematically predictable, recurring subscription revenue. Estee Lauder just removed the massive, lingering uncertainty of a complex corporate merger.
You've isolated the exact driving force behind this pre-market rotation.
Yeah.
We are operating in a global market entirely dominated by massive, uncontrollable forces.
Right.
You have geopolitical ambiguity in the Middle East that no algorithm can accurately model for, and you have the macroeconomic gravity of a 4.58% risk-free rate pulling down historical valuations.
It's just a lot of pressure.
In that kind of high-tension environment, capital naturally seeks shelter in companies that control their own destiny. Workday controls its destiny through sticky, enterprise-level recurring subscriptions.
And Estee Lauder.
Estee Lauder is taking back control of its destiny by walking away from boardroom drama and focusing purely on internal operational efficiency and margin expansion.
Right.
Neither of these companies is reliant on an unexpected ceasefire in the Middle East, and neither of them is reliant on a fragile supply chain of specialized data center plumbing.
They are masters of their own domain. Okay, let's pull all of these threads together for you listening, because there is a tremendous amount of data to digest before this opening bell actually rings.
There really is.
We're looking at a broader market that is essentially paralyzed in a liquidity trap. It is caught squarely between the undeniable, massive potential of artificial intelligence and the severe, immediate realities of geopolitical friction and high borrowing costs.
The tactical playbook outlined in this institutional dossier is very clear for today's session. Do not chase the mid-range price action.
Stay out of the shop.
Exactly. The volatility and the algorithmic chop in the middle of these ranges will just stop you out and erode your capital. The institutional strategy is to either stay in cash and protect your powder, or strictly play the extreme edges of the support and resistance levels we outlined.
And most importantly, keep a hawk eye on that 10-year Treasury yield and the DXY dollar index.
That is paramount. Understanding how those macroeconomic forces act as gravity on tech valuations is what keeps you out of the pain trade blind spot.
Which is so easy to fall into.
It is. That is the trap that consistently catches retail investors who only look at a company's earnings growth, while completely ignoring the brutal mathematics of how rising yields compress the multiples of those stocks.
Which brings us right back to where we started our dive today. The chair at the Federal Reserve is empty, leaving the market without a compass.
Right.
And as we sit here waiting for the bell to ring and the trading day to begin, I want to leave you with a final thought to mull over this weekend. We've seen today how a physical supply chain bottleneck involving specialized liquid cooling or a naval blockade in a strait halfway across the world can literally erase billions of dollars in digital tech momentum overnight.
Yeah, in a flash.
Are we quietly entering an entirely new era of the market? An era where raw geopolitical logistics and physical real-world constraints dictate your portfolio's survival far more than the next major breakthrough in artificial intelligence.
In a world where digital ambition is colliding with physical reality, that might just be the real $30 trillion question.
It certainly is. Thank you for diving deep with us today. Keep your risk managed, watch those bond yields closely, and we will see you on the other side of the closing bell.